Let's get to the big story breakdown. In midweek trade, we are looking at U.S. stock futures lower, and this does come after the major equity averages tumbled in the previous session to mark their worst day since October of last year. And this did come as Trump's push for U.S. control of Greenland reignited global trade war fears. And Japan's long-term bond yields hit record highs on election-driven tax cut worries as global yields rose. And Fed Chair Jerome Powell is expected to attend Supreme Court oral arguments today in a case involving the attempted firing of Fed Governor Lisa Cook. Now, Powell's planned appearance does come as the Supreme Court could also rule as soon as next week on a separate case challenging Trump's tariffs. Now, joining me this morning here at the New York Stock Exchange is Ed Al-Hussainy, portfolio manager of Total Return Bond Fund with Columbia Threadneedle. Well, good morning. Thank you so much for joining me.
Good morning. Awesome to be here.
Yeah, and of course, first and foremost, a lot has happened so far as we kick off 2026. But I do want to start out by looking at global fixed income, especially given the market action, not just in the U.S., but also in Japan yesterday. So what does diversification look like now?
Yeah, fantastic. So let me start with the credit side of the story. Credit has been really well behaved. If you look at both investment grade and high yield corporate credit spreads, they've been very, very stable. There's not been a lot of volatility. They're a little bit wider over the course of the past couple of days, but really reflecting the key source of uncertainty, which is what's going on in the interest rate market. A lot of volatility in interest rates, very little of volatility in credit spread so far, really reflecting the fact that on the corporate side, balance sheets are still quite healthy at the start of the year.
Yeah, and you mentioned central banks, which we are paying attention to here in the U.S. And of course, there's been a lot of volatility when it comes to policy. So given what we're seeing right now, how would you characterize the Federal Reserve's strategy?
Yeah, so the Fed's strategy was pretty clear over the course of the last 18 months. We're trying to add some accommodation to the economy, really reflecting the fact that the labor market was slowing. We've now come to a point where they're comfortable taking a pause. It's anybody's guess as to how long that pause is going to be this year, but it's clear here at the start of the year that the pressure on them to cut rates isn't really there. And so the interest rate market is now starting to price in a pretty wide range of outcomes. Some of the volatility we're seeing in rates is reflective of that, reflective of the fact that the underlying growth story is a little bit better here at the start of the year than markets were anticipating maybe even 6 months ago.
Yeah, and of course, we're paying attention to growth here in the U.S. We will be getting revised GDP figures, but we saw that bump up at the end of last year, at least for the first reading of third quarter GDP here in the U.S. But given everything that's happening globally as well as here in the U.S., how do you see growth moving in 2026?
Yeah, the growth was unusually high, I would say, last year, a little bit over 2% for the full year. It's likely that we are on track for slightly lower growth this year. I don't think anything's falling out of bed, but somewhere between 1.5% and 2% is a really good bet. The key issue in the economy isn't really growth, and that's what markets have been paying attention to. Number one, it's inflation, and inflation has been really well behaved, coming down over the course of the last 6 to 12 months. Number two, it's the labor market, and the labor market has really been on the weak side. That's been the key source of concern. How the labor market resolves itself this year is really the number one issue top of mind in fixed income markets.
Yeah, and speaking of which, what are your forecasts when it comes to those key numbers, those data points surrounding the labor market as well as inflation this year?
Really, really tough. I have a little bit more confidence around inflation. The inflation story, really kind of zooming out over the course of the past 3 years, has been really good. The Fed has done a very decent job in terms of bringing inflation down without triggering a recession as a cost of that decline. Inflation right now is somewhere between 2.5% and 3%. It's not quite at the Fed's target, but it's pretty well behaved and pretty close enough. I think that decline continues this year towards that 2% level. I don't think we quite get to 2%, but the direction of travel is marginally lower. When it comes to the labor market, huge question marks. Extraordinarily difficult, I think, to make a forecast at the moment. What we know is hiring is very low, so all the growth we've had this year hasn't really translated into hiring. We also know that we have a much smaller working population because immigration has declined. The two have netted out in the form of the unemployment rate rising about a percentage point right around to 4.5%. I think it moves slightly higher this year, and I think the Fed's going to have to do a little bit more work to make sure it doesn't accelerate, which would be a bad thing for the economy.
And I do want to ask your perspective when it comes to the tension between the Federal Reserve and the White House right now. Today we will be zooming in on that hearing for Lisa Cook, and Powell will apparently be in attendance. But what do you make of this, and how do you see all of this shaking out?
Yeah, I mean, it's an unprecedented period for the Fed. We have both the White House challenging the Fed in terms of being able to replace sitting governors, the Lisa Cook case. We also have a new Fed chair in the wings somewhere with that announcement coming, imminently. That's a very difficult transition for the Fed. The Fed is clearly being politicized, and there's a lot of pressure from the White House. Two key things I think are really important. Number one, there's great consensus on the Fed at the moment that there isn't a need to cut rates, at least in the short term. Call it the next 3 to 6 months. It's going to be really tough to challenge that consensus, even with a new chair coming in. That's one. That's a short-term issue. The longer-term issue is to what extent will Congress, and particularly the Senate, step in and provide some degree of cushion around the Fed to protect that independence. In the absence of that, the White House has a lot of license to keep pushing over the next couple of years and effectively remake the Fed, make it a lot more political. That would be very toxic for risk assets, very toxic for markets. Given that outcome, given that risk, I think there's going to be a lot of pushback against what the White House is trying to do.
Yeah, and finally, before I let you go, we can't have a conversation without talking about uncertainty, tariff risks, as well as geopolitics. So given all this uncertainty, we saw stocks sell off, the U.S. dollar sell off yesterday, and we also saw global bonds lower. So what do you expect to see when it comes to bonds, specifically the 10-year?
Yeah, when I think about the lessons of 2025, when we have a source of geopolitical risk or anxiety that's coming from the White House, tariffs in April of last year were a really good example. What foreign investors tend to do is hedge the currency risk, taking the dollar lower. There isn't necessarily much selling of U.S. assets, but clearly the release valve is a weaker dollar. I think that's what we're seeing at the beginning of this year. In terms of the 10-year yield, look, the 10-year yield is getting to levels that I think are quite attractive. 4.5% on the 10-year is definitely within reach. 5% on the 30-year is definitely within reach. I think from an investor's perspective, these have got to be quite attractive levels to lock in a little bit of income against risk assets that are quite richly valued at this stage.
Well, Ed, we will have to leave it there, but thank you so much for joining me, and thank you so much for sharing all of your insights.
Thank you.
Thank you.